Nikita Singhal is the co-head of Sustainable Investment and ESG at Lazard Asset Management, a $180 billion global asset management firm. She oversees the firm's sustainable investment and ESG integration strategies, leads client engagement and thought leadership on ESG topics. She's been working in the field of sustainable investing for over 14 years across asset classes and value chain of financial services, and has an MBA from Harvard Business School. Please join me in welcoming Nikita Singhal to the podium. Nikita?
Good morning, everyone. Can you hear me all right? The back. Thank you. I hope this is going to be a really exciting summit. I was just looking at the agenda, and there's some really very specific technologies and markets that you are going to be hearing from, so that's really exciting. The way I see it, I guess my role here today, hopefully, is to give some more background and context on what we're seeing as investors, specifically at Lazard Asset Management. And I thought I would spend about maybe just 10 minutes giving you a little bit of the backdrop as it pertains to regulation and the SEC, of course, but I think that conversation is not possible without a bigger context about where ESG came from, why we're facing the issues that we're facing today, whether it's politicization, on this side of the Atlantic to greenwashing concerns on the other side. And also an understanding of why I think the conflation exists in the marketplace because of some inherent challenges that ESG has. So that's kind of my hope to share with you a little bit about today. To start with, the history of ESG, right? Many of us are hearing ESG splashed across newspapers and the media today. There's a deep kind of politicization of the space. But what I would say is that it's almost a healthy reckoning. As somebody who has ESG in her title, I am happy that this is happening. I think it's a much needed debate, and I can understand why it's happening because it stems from where ESG comes from. ESG's forefathers can be called socially responsible investing, faith-based investing, these types of investing that go all the way back to the 1700s, perhaps in line with the Methodist movement. And you saw investing across various faiths, not just Christianity, but Jewish faith, Islamic faith. There has been a tradition where people invest alongside their values or in line with their values. Over the decades, there was the trend to invest alongside other values, not necessarily religious values, and you saw this with the Vietnam War, you saw this with the apartheid movement in South Africa, and as that iteration of socially responsible investing kind of matured, we are where we are today, where we call it ESG, environmental social governance. Now, I think the definitions get really important, and this is where it gets tricky because the way we define ESG, or I personally define ESG, is about discovering and pricing environmental, social, and governance risks and opportunities. It's not about your moral perspective. It's not about political view. I think especially as fiduciaries in my job where I sit, it's not my job to impose my personal values, let alone an institution's values on our clients' money or on companies that we invest in, right? You and I may care deeply about very different things. Some of you in the room may care deeply about mitigating climate change and finding solutions to adapt to climate change, whereas me personally, I may care deeply about socioeconomic development in emerging markets in countries like India, where there's still 300 million people that don't have access to a light bulb. And those choices can often come with inherent trade-offs. So to say that we can be evangelical about this is something I personally don't understand, and where I find my discipline as an investor is to say it's not about us choosing where we want the world to be or where it quote unquote should be, but rather about where we think these issues are starting to get priced into the markets, and those they are. Regardless of whether we call this ESG, sustainable investing, impact investing, every acronym, and you've heard in this alphabet soup, the underlying trends are unmistakable. We are seeing a structural shift in the world towards more sustainable practices. And what this means is recognition of issues like climate change, healthier living habits and choices being made by consumers, customers of tens of thousands of businesses around the world, and a recognition of the importance of worker livelihoods, which is, regardless of political bent, an issue that everyone is focused on. These things are starting to get priced into the market. And this is what we want to be focused on as investors, is saying, how do these issues start to then get priced in via catalysts? And what you heard just in the earlier session today, regulation is one of the biggest pieces. The Inflation Reduction Act is arguably the largest piece of climate legislation to come about in the world, certainly out of the United States. And it is already galvanizing action in a way that it's disrupting certain supply chains, how companies decide where they want to manufacture, how they want to manufacture, and in many instances, shifting their product mix. And what that does is, as analysts who are covering those companies, that shifts how we think about the organic revenue growth rates of those companies, their margins because of their ability to compete in those industries, their capital expenditure plans, their research and development expenses, all the way through to how it impacts their cash flows. And in some instances, issues, especially far-out technologies that are already being regulated, we have no idea how it's going to impact companies in that space. But what we do understand is that it's creating volatility in those sub-industries in a way that we need to ascribe a higher discount rate because we think that the cash flows are going to be more volatile. So as you can see, a lot of the debates and the discussions we're having within asset management firms like Lazard is not about what's the right thing to do or how can we save the planet. That's not our job. Our job, and the best way actually you can affect change as investors, as corporates, is to factor these issues into your financial models. And that shows that this is not a PR or marketing exercise. It's not us feeling good about ourselves so we can sleep well at night. But it's actually just doing the right thing as a fiduciary and letting markets do their job, which is price things in at some point where they become so efficient that that's part and parcel of how financial modeling occurs. So one way I would kind of sum it up is I actually think ESG is one of the greatest alpha generation opportunities in our lifetime as investors. And think about this, wherever you are, sit in the value chain. If you're a corporate looking for capital, if you're a investor looking to generate alpha for your clients, environmental and social issues today are still so disparate that there isn't a common way for us to build that into our financial model. Now, you can lament about the challenges of ESG data, and I'll get to that in a minute, but that's exciting? Because how often is it that as investors you find an issue that is not efficiently priced into the markets, especially if you cover developed markets like the US? Do you have a different opinion, or how hard do you think it is to have a different opinion on a company like Microsoft or Apple? It's very hard to have a view out of consensus. But these issues are not systematically priced into the market, and by studying things like what really do you think might be the implied cost of carbon, not because there's going to be, because of the cost of capital implications on supply chains and costs of doing business, you might suddenly have a different view about a very large company that otherwise is hard to have a different view about. So I would argue it's one of the greatest alpha generation opportunities of our time if one remains focused on not imposing your values, but actually saying what are the catalysts, whether regulatory, whether shifts in consumer behavior, or technological disruptions around sustainability issues that are starting to get priced into the market. And as a disciplined investor, how do you put a probability to that? How do you do a bull-bear kind of base case, model around it, and then probability adjust that to get to what your target price is? It's very much the conversation, I think, on Wall Street where people are doing ESG right, and everything else that you hear, in my opinion, is noise. Right? There's a lot of noise in the space. I've talked a little bit about our definition of ESG and how to do it right. Let me come to the challenges that I alluded to earlier. The greatest challenge that everyone talks about is data, and hence the reaction or the regulatory response to that is also around data. Now, I do think that data is challenging in the ESG space. It's very hard even for the most common form of data, like carbon emissions, even something like Scope 1 emissions, which is what you're generating on your own by if you're burning fossil fuels in your own location, that is hard to get consistent data on across the industry. Even if you look at the S&P 500 or the MSCI ACWI, the disclosure rate even for something like that is not significant. But at the same time, what I will say is that ESG is very early on in its journey. Now, it might seem like a contradiction because I started out saying that the forefathers of ESG go back to the 1770s. But in its current form, as we think of ESG as a market discipline, a process of discovering and pricing ESG risks and opportunities, is very early. I would liken it to where the financial markets were pre-SEC. So think about if you were sitting here today, we had no SEC, we had no FASB, we had no frameworks for thinking about financial analysis. There was no Miller-Modigliani structure for optimal capital structure framework. There wasn't a Eugene Fama-French model. These things don't exist in ESG land today. We don't have accounting principles. We don't have standards for benchmarking. We don't have frameworks for thinking about risk, return, and impact. So it's very early days. And for that, I think we just all need to take a breath and say it's okay. ESG is going through its teenage growth spurt, as one of my industry colleagues likes to say, and we have to be patient as we start to discover what elements of ESG really matter. And the name of the game there, in my mind, is financial materiality. When you look at ESG data, there are 4 major challenges with ESG data, and it's best articulated in a paper called 4 Things No One Tells You About ESG Data by Professor George Serafem at HBS, at Harvard Business School. And the 4 things that he talks about is that the data today is inconsistent, it's not comparable, it lacks consistent benchmarks, and those 3, I think you can all understand, right? You might have total incident rates where there are, let's say, failures in safety and resulting in injuries or losses at companies. And those rates will differ depending on 2 companies, even in the same sector. So 2 mining companies have 2 very different ways of describing their safety metrics and failures or injured losses. They're not comparable even for the same company over time, because companies tend to cherry pick data. They'll give one metric one year, another metric another year. It doesn't even go back more than a couple of years in some instances. So it's not consistent, it's not comparable. The third one is not benchmarked. And this is something you all may have heard of, again, depending on where in the value chain you are in this space. The correlation of ESG ratings, now there are ESG data providers, right? It's still a bit of an oligopoly in the space, MSCI and Sustainalytics being 2 of the largest. The correlation of their ratings is 0.3 to 0.5. And if you compare this to the correlation of, let's say, a S&P and Moody's bond rating, that's closer to 0.7 to 0.9. So you can see how varied the opinions are, and this is why, I can kind of sympathize why someone like Elon Musk would be so upset that Tesla gets dropped from the S&P ESG index while an oil and gas company still gets to be there. There's inconsistencies in what constitutes a good ESG rating even today. And often I've seen that ends up being because it depends on what you're benchmarking the ESG performance of the company to. Are you benchmarking it to its peers, to an industry, to a region? And depending on what your benchmark is, and if you're doing also an absolute or a relative assessment, a company might end up looking very bad or very good, the same company. So consistency, comparability, benchmarks. Arguably the most important challenge in ESG data is the 4th one, which is financial materiality. And I think this is why it becomes really important that even if regulation comes in and it solves all of our challenges of consistency, comparability, and benchmarking, which is part of what, SFDR, the European funds regulation, and the corporate regulation that they're now coming out with is trying to solve, it's not going to solve our materiality question. There's a really good paper by Professor Bob Eccles at Oxford called Fewer, Better, but Fewer, where he argues that at the end of the day, it's maybe 1, 2, or 3 ESG issues that might actually financially impact a company. You might be talking about, for example, water scarcity risk. It is a real risk for corporations, but even for consumer beverage companies, for whom water is the key, raw material input, it's 3 to 5% of their COGS. And if there happens to be a water scarcity issue in some part of the world, it's likely to cause some level of business service interruption, but the bottom line impact on the stock at the end of the day is not, perhaps not material. So thinking about materiality becomes really important. And in order to do that today, you can't do it unless you are a fundamental bottom-up investor. And I'm sharing this hopefully it's helpful even from a corporate perspective, because corporations are inundated now with requests for ESG data. They fill out thousands of surveys. All these organizations, nonprofits that have, come in, and some for-profits, as regulation has not crept up yet, these data providers are collecting thousands of data, but most of that data is not material. It's meaningless, and it's just swarms and swarms of beautiful looking sustainability brochures with data that actually doesn't impact the analysis that investors are undertaking. So the key point I would make is, for data, you need to focus on financial materiality. And that's what I'm kind of excited about in terms of the now developments that we're seeing on the regulatory front. So I'm happy to answer any questions and get more into it if you're interested.
Thank you very much, Nikita, for those comments. And we have time for probably one or two quick questions. We've covered a lot of ground here in the last 15 minutes. Here we go. Yes, give us your name and your company, please.
Yeah, Philip Rose from Energy Intelligence. You said at the beginning something like the current politicization of the debate in the US is almost a good thing. Almost means it's not a good thing. Could you elaborate a little bit? I mean, I've talked recently with a couple of asset managers who told me it's really difficult to deal with with a country where half of the states say ESG is bad and the other half say ESG is good. So how do you deal? And I have another question which is quite different.
Let's answer the first one, please.
Yeah. I think in terms of, so the question was about how to deal with the politicization, and I think the way we deal with it is by clarifying definitions. So when you have somebody ask us, how is ESG contrary to fiduciary duty, you would think, actually, by my definition, if you're not considering issues like the energy transition or worker livelihoods or changes in consumer behavior around healthier, more sustainable living, that's impacting the multiples of companies that we invest in, it's impacting their financial productivity, you're not letting us do our job. So it's about clarifying definitions. I do agree that if you are imposing your values and suggesting that companies should shift their businesses because you think that what they're doing is immoral, that's not right. And so I think that if actually once we clarify definitions, most people would actually agree with what we're doing. The word itself has somehow become a lightning rod that we have to just be careful to clarify.
One more quick question.
Hi, good morning. David Oliver here from DevStream. Quick question about the investment categories, or if you can classify your way of thinking or seeing the world, how you structure your investment strategies on on the ESG space, of course.
Thank you for your question. Yeah, this is something I often try to share with people. ESG should not be a product. It's not a product. What does that even mean? That means you're suggesting that certain companies owned in those products are good and others are bad. Everything in like fossil fuels, right? Fossil fuels are pervasive in our lives. Everything from the plastic in the toothbrush to the food we're eating that was enabled by fossil fuels. So to give it a bad rep and say that this is a bad company and therefore it cannot be owned in an ESG product, that's just conflating the definition of ESG. So I think ESG should be a process. It's part and parcel of every disciplined investor's toolkit, but it is not a product. Now, there is a healthy and growing subset of clients around the world that are interested in investing in companies that are making the world more sustainable, making the world greener, safer, healthier, fairer. And those are sustainability strategies that one can design. And I would kind of consider those as like sustainability-focused strategies, where the companies in those strategies are inherently experiencing tailwinds, whether in their valuation or their financial productivity, because they're serving a sustainability challenge.
Thank you very much, Nikita, and we are very happy that you were able to join us today for the 22nd Annual Wall Street Green Summit.
Thank you, everyone.